Okay, let's dive right into this. Welcome to today's Explainer, where we're going to follow the journey of a guy we'll just call Bob. Bob is our hand-drawn stickman hero, and honestly, right now, he is completely exhausted. He's staring down the barrel of a traditional 9-to-5 grind that stretches endlessly into his late 60s. But today, we're giving Bob an escape route. We're going to break down the absolute cutting edge of financial independence, unpack the historical math behind early retirement, and reveal some incredible high-income tax hacks that are updated specifically for 2026.
So ask yourself this. What if you could retire 20 years early? Seriously, think about it. For decades, society has basically fed us this idea that retirement is just an age. You hit 65, you get a gold watch, and then you finally start living your life. But what if retirement isn't an age at all? What if it's literally just a mathematical equation? The truth is, early retirement isn't just some pipe dream reserved for tech billionaires or lottery winners. It is a mathematically proven roadmap that thousands of people are using right now to buy back their time.
And that roadmap actually has a name. It's called FIRE. That stands for Financial Independence, Retire Early. At its core, this movement is a personal finance phenomenon that takes traditional advice and just completely flips it on its head. I mean, if you sit down with a traditional financial planner, they're probably going to tell you to save a nice, respectable 10 to 15% of your income for retirement. And hey, that's perfectly fine if you want to retire at 65. But the FIRE community? Yeah, they look at that 10% as a snail's pace. Instead, they prioritize extreme, aggressive savings, aiming to accumulate a massive asset base that generates enough passive income to cover their living expenses indefinitely.
So to really fast-track this timeline and break out of the whole hamster wheel early, you've got to hit some pretty wild numbers. We're talking a 50% savings rate, or even higher. A lot of FIRE advocates literally aim to save half of everything they make. Let's think about the math behind that for a second. If you save 50% of your income, it means for every single year you work, you are buying yourself one full year of freedom. If you manage to scrape together a 75% savings rate, even if you completely ignore investment growth, it would take you fewer than 10 years to accumulate 25 times your annual living expenses. It's not magic, folks. It is just pure, aggressive math.
Section 1. The 4% Rule. Exploring the mathematics of early retirement. So, to figure out when you can actually pull the plug on work forever, we really have to look at the math. And this brilliantly illustrates the core shift in mindset here. On one side, we have traditional retirement. You know the drill. You work, you earn a paycheck, you spend it, and repeat. Your income is directly tied to your labor. But on the other side, we have the FIRE retirement model. The whole goal here is to accumulate an investment portfolio that equals exactly 25 times your annual living expenses. So if you figure out you only need $40,000 a year to live happily, well, you need a portfolio of $1 million. Now, why 25 times? Well, that brings us to the inverse math. 4%. This right here is the magic withdrawal rate. Back in 1994, a financial planner named William Bengen introduced what we now call the 4% rule. It basically suggests that if you have a properly diversified portfolio of stocks and bonds, you can safely withdraw 4% of its value in your first year of retirement. Then, you just adjust that withdrawal amount for inflation every single year after that, and historical data suggests you won't deplete your portfolio over a standard 30-year retirement. Now think back to the last point. 1 divided by 4% equals exactly 25, and boom, that is exactly where the 25 times expenses rule comes from.
Section 2. Is 4% safe? Let's talk about sequence of return risks.
Here's the thing. A standard retirement usually lasts about 30 years, right? But a FIRE retirement, that could easily stretch 50 or even 60 years. And that introduces some massive sequence of return risks. Basically, if the stock market crashes right after you retire, your portfolio might never actually recover from those early withdrawals. Now, what's really interesting here is the data behind the infamous Trinity study, which is what famously backed up the 4% rule in the first place. When you look at the maximum sustainable withdrawal rates from overlapping historical periods, the Trinity study actually found a 96% success rate for the 4% rule over 30-year chunks. But we need to look closer. Researchers like Dr. Wade Pfau have pointed out that this 96% success rate relies almost entirely on U.S. historical data during a century where U.S. markets performed just incredibly well compared to the rest of the world. So, expecting those exact flawless returns to continue for the next 50 years, that might be a misleadingly rosy picture.
Because of that exact risk, a lot of modern researchers, including economist Carson Jeske, actually advocate for a much more conservative approach for early retirees. They suggest aiming for a 3.25 to 3.5% safe withdrawal rate instead. Doing this protects you against extreme market volatility over a potentially 50-plus year retirement. But
Yeah, there's a catch. A 3.5% withdrawal rate means you no longer need 25 times your annual expenses, you now need roughly 30 times your expenses. So sure, it pushes the finish line a little bit further away, but it adds a massive, absolutely crucial layer of safety to the whole plan.
Section 3. Building your fire engine. Moving to tactical execution.
Okay, so how do we actually build this portfolio? To do it efficiently, we follow what's called the financial order of operations. First up, you absolutely must secure your employer 401k match. This is crucial because an employer match is literally an immediate, risk-free, 100% return on your money. Mathematically speaking, it beats everything else, period. Second, you gotta crush any high-interest consumer debt. We're talking anything over 8%. Third, build up a solid 3 to 6 month emergency reserve. That way, you never have to sell your investments during a market panic. And finally, max out all your tax-advantaged retirement accounts. Following this exact sequence minimizes your risk while totally maximizing your compound growth.
So, once the money is actually flowing into those accounts, what are we buying? Well, the most popular strategy in the FIRE community is stunningly simple. It's called the Boglehead 3-Fund Portfolio. Instead of trying to pick individual winning stocks or handing over high fees to active fund managers, you just buy 3 broad index funds: a U.S. stock index fund, an international stock index fund, and a bond index fund. That's the whole shebang. It gives you fantastic, low-cost, global diversification. Plus, it requires almost zero maintenance, keeps your fees under 0.10%, and acts as the perfect, steady, long-term growth engine to power you right toward financial independence.
Section 4. Maximizing 2026 Tax Limits. Advanced Wealth Hacks.
Now, let's say your career is really taking off. Your income is high, and you want to literally pour gasoline on this FIRE journey using the updated 2026 tax codes. Most people know about the standard 401k limit. For 2026, the base elective salary deferral limit is $24,500. But here is the absolute secret hiding in the tax code. The total 2026 defined contribution limit, which is the maximum amount of money that can go into your 401k from all sources combined, is a whopping $72,000. There is a massive $47,500 gap between what you can defer from your salary and the total legal limit. And let me tell you, that gap opens the door for one of the most powerful wealth-building tools in existence.
Let's see how this builds into the famous Mega Backdoor Roth strategy. Step 1, you max out that standard $24,500 salary deferral. Step 2, you take advantage of that massive leftover space by making what are called non-Roth after-tax contributions directly into your 401k. Then Step 3, you immediately execute an in-plan Roth conversion, moving those after-tax dollars straight into a Roth 401k or a Roth IRA. And since you already paid taxes on that money and you're converting it before it has a chance to grow, there are little to no taxes due on the conversion itself. By doing this, you've just magically shoved nearly $50,000 of extra savings into a permanently tax-free Roth account in a single year. No way, right? It's a total game changer.
But, okay, I do have to caution you here. The Mega Backdoor Roth is highly plan-driven. Not everyone can actually do this. Your specific employer's 401k plan must explicitly allow non-Roth after-tax contributions. It also must allow in-plan conversions or in-service distributions so you can get the money into a Roth status quickly. On top of that, the plan has to pass strict IRS ACP testing, which stands for actual contribution percentage. Smaller companies actually fail this a lot if their executives are saving way more than regular employees. And finally, the plan needs separate sub-account tracking, because without it, your tax filing becomes an absolute nightmare. If even one of these links breaks, the whole strategy just falls apart.
Which really brings us to the final hurdle here. Is your employer's plan actually built for the Mega Backdoor Roth? Honestly, most people have absolutely no idea what their summary plan description even says. If you are on your own FIRE journey and you're aiming to escape that hamster wheel decades early, you have to understand the deep plumbing of your 401k. Mastering the math of the 4% or the 3.5% rule and relentlessly optimizing your savings rate, these are literally your keys to the kingdom. So, I'm going to leave you with this. When was the very last time you actually read the fine print on your company's retirement plan? Because honestly, the answer just might buy you 20 years of freedom.